Hello students, I welcome you all for our new session, and today we are going to discuss fundamentals of capital budgeting and some part of working capital.
Let's see capital budgeting. Capital budgeting means we have a list of the project, right? And we need to see A, B, C, D, right? So for project A, we can have different criterias, NPV, IRR, right? Profitability index. So this is basically, this A, B, C, D is called capital budget. Capital budget is the list of the projects that the company plans to undertake in the future. And capital budgeting means evaluation of these projects based on investment decision rule, right? So these were investment decision rules. Budgeting means we have to evaluate, and budget means we have to think the list of the companies that could be our project. And capital budgeting are evaluated by calculating NPV. As we just know, in the last topic we discussed NPV, right? IRR and all that investment decision rule. And normally the most widely used approach is NPV, right? And NPV is normally calculated as present value of cash inflows minus present value of cash outflows. Remember, this cash inflow and cash outflow together we can call them as cash flows, right? So these are called cash flows. So cash flows mean cash inflow as well as cash outflow. So it means when we are calculating NPV, one of the main component is the cash flow, right? So we calculate its present value, and this chapter basically will talk about how to calculate cash flows. Okay, so I will explain it in detail. Okay, next, this is the incremental free cash flow. Now we have a cash flow. Cash flow is, we have a cash flow, and I told you that in cash flow can either be outflow or inflow. Okay, so what is this incremental then, right? Incremental means if this cash flow is adding any value to the existing company's profitability, right? Incremental, right? So for instance, if you see if you see from the previous example, this one, the old project was giving you the sale of 100 and the new project is giving you 120. So what is the increment? Increment is 20. How much extra? So that is why we need to find extra cash flows that would be adding value in the worth of the company, right? Extra cash flows. Okay, cash flow could be either inflow or an outflow. Now we need to actually calculate these free cash flows, but before understanding this, before coming to a free cash flow, we need to see that, for instance, we have a project, right? We have a project and it cost 100,000, right? So it means initial cash outflow is 100,000. So this project is for 2 years and is equal to 2. Okay, so for instance, when a project is initiated in a company, it will affect sale, and in affect sale it can maybe increase the quantity, right? Or it can increase the production. After that we have a cost, CGS. How can we calculate the CGS? Cost per unit multiplied by quantity, it will be equal to CGS, right? So sale is 140 in 1 year, in second year it is 160. So and the cost of goods sold is 80 and 80. So what is the gross profit? 60 and 80, right? So this is called first type of profit that we should use, right? But we think that gross profit is not okay. We should also consider some other profits. Okay, so this is accounting profit number. This is accounting profit number 1, right? Then we subtract salaries, we subtract rent, and we subtract depreciation. How do we calculate this depreciation? It could be straight line. Maybe in accounting we have heard about this straight line. Then we have a declining balance method, and then we have Macker's method, right? So we can calculate this 10 by straight line or maybe declining or Macker's. So this is another topic that we will cover. And then we have earning before interest and tax. This is accounting profit number 2. Accounting profit number 2. Okay, then we do not, at this moment we do not subtract any interest rate. We leave it at 0. So our earning would be EBT, earning before tax. After tax, after EBT we deduct tax. For instance, it is 50%. Our answer would be 15 and 15. And EAT is called net income, and this is called accounting profit number 3. Okay, so this is accounting profit number 3. But after that, if you see, I'm adding depreciation to calculate cash flow, that is called free cash flow. Okay, so why? So if you see this statement, the question says, why do we focus on the cash flows and not the accounting profit? It is because accounting profit could be misleading, right? Its profits could be manipulated. For instance, if you see this 60, right? 60 is the gross profit, salaries is a cash expense, rent is a cash expense. But if you see this depreciation is not a cash expense, it is a non-cash expense, right? So if you see your profit EBIT is 30, but if I ask you how much is the cash in your pocket, you will say the cash is 40. Why? Because this is a non-cash expense. You did not pay in cash. This 60 is in cash. You subtract 10, and the remaining cash balance is 50, and then you subtract 10 again. Now your cash balance is 40, right? But this 10 is the expense that you didn't pay the cash for, right? So that is why you are getting 30 as the accounting profit, but in actual your profit is, your cash is 40, right? So that is why we do not actually use accounting earnings for our estimation. Rather we go for the cash flows. And now you will ask me, sir, then why? It's simple. If we are adding back the depreciation here, then what is the purpose of subtracting the depreciation here, right? So that is a reasonable question. But if you see, your profit is EBIT is 30. So if you see the tax is how much? 15 50% tax rate, so it is 15, right? So your earning after tax is 15. So because when you do the depreciation, when you do deduction of depreciation, your tax will actually decrease, because your taxable income will decrease. If there is no depreciation here, okay, then it means it would be 40, right? And your tax would be 20. But because of this depreciation, you are saving some much, right? So how much? If it was 40, your tax would have been 20, right? So how much is the saving? 5, right? So that is why you can save $5 of your earning by just first reducing this depreciation expense. Okay, so your answer is 15. After that, it's a lot to add back the depreciation, because you have previously deducted this 10, that is a non-cash expense, and you get 25. Okay, now how much is the tax benefit, you can also calculate. Okay, so how much is the depreciation? If you see, depreciation was 10, right, multiplied by tax rate is 50%. How much are you saving? 5. So this 5 is saved due to this depreciation, right? So that's why you are paying this 15, not 20. Okay, so that was just a little bit explanation. So the first question is that we focus on the cash flows, not accounting profit, because a capital budgeting is forward looking, right? Forward looking mean we have some cash flows in year 1, year 2, year 3, and we need to discount it back to find the present value of cash inflows, right? So that is why it incorporates time value. But if we just use the accounting profit, like we can simply do 30 plus 40 is equal to 70, right? So that is just simply adding, but we are ignoring the time value of money. So in the capital budgeting, because we can incorporate time value of money, so that is why it is called forward looking. Okay, and it is important to note that the negative free cash flow is not a bad idea. So this is, I will explain in the coming slide. At this moment you will not understand. Okay, so if you see this slide, in evaluating capital budgeting project, number 1, the cash flow we discount in NPV analysis are incremental after tax free cash flow. So after tax mean we have deducted the tax here, right? And incremental mean how much it has added more, 25 it has added more in the value of the company, right? In year 1 and 30 in year 2. Okay, now if I draw a timeline would be it would be 100 was your outflow, 25 is in year 1 and 30 is in year 2. So these are incremental free cash flows. Okay, so what is the process of capital budgeting? Of course, we need to first calculate the incremental earnings, right? And then incremental earning means net income, right? After getting the net income, we convert it into cash flow. How do we do it? By adding depreciation. Okay, and then once we have the cash flows, we can draw a timeline. So that is 0, 1 and 2. So that was 25 and 30. In the previous case, if you remember, $100 was the outflow and 10% is the discount rate, right? So determine an appropriate discount rate. For instance, it is 10%, and calculate the NPV. NPV is very simple, simply present value of cash inflows minus 100,000, right? So simply discount these one, 25, 1.1 power 1 plus 30, 1.1 power 2, okay, minus 100. So you can simply calculate the NPV, right? So that is a capital budgeting process, and decide whether to accept or not. Yes, based on NPV we can decide whether should we accept it or reject it. Remember, this is a capital budgeting process. We in the previous lecture you were given cash flows directly, 0, 1, 2, 3. After that you had to calculate NPV, right? So actually now we are doing these 2 steps extra, right? These are the 2 steps that is the main theme of this chapter. Step 3 is basically a new chapter. In next class we are going to discuss this topic. Okay, new chapter is appropriate discount rate. So for this topic we are going to calculate incremental earnings and converting them into cash flows. So this is just a format for incremental earning. Okay, number 1, incremental earning is the amount by which the firm's earnings are expected to change as a result of an investment decision, right? So I just told you in the previous example, if you see, so what are the incremental earnings? Incremental earnings were 15 and 20, right? So these are the incremental earnings. Mean now the company worth would increase in year 1 by 15 and in year 2 by 20. Okay, So how do we start it? This is the income statement. This is called the pro forma of the income statement, where we actually expect, because we don't know what would be our cash flows, right? So revenue, how do we get it? Revenue is also called sale, so it could be calculated as price into quantity. Cost of goods sold is C into Q, right? The first profit is called the gross profit. It is the profit after deducting your manufacturing expense. After that we have operating expenses, and then separately we have depreciation. If you see, okay, separately depreciation, we have three methods: straight line, then we have declining, and then we have methods, right? So remember, we will discuss this as a topic, new topic. Okay, how do we get this one? Because we can change this depreciation. When we change this depreciation, EBIT will also change. So that is why accounting profit can be manipulated by changing any policy. If we change from straight line to the depreciation, EBIT will change, right? After that, if you see, we are not subtracting interest rate. Sorry, we are not subtracting interest rate, right? Why? Because it will be part of your cost of capital. We will be dividing it, and I will explain it to you when we will go specifically discuss this chapter. Okay, income tax. After that, earning, incremental earning, and this means unlevered net income. Unlevered mean we haven't subtracted interest. Okay, interest is not subtracted, so that is why without subtracting the interest, the earnings is unlevered. Okay, so there is no interest included in that earnings. Okay, so please make sure that you understand the term incremental. Incremental means previously company was doing well, but with a new project, how much this new project is adding, right, in the earnings of the company is called incremental, right? In the previous example it was 25 and then 30. Now we need to understand forecasting the incremental earnings. How can we forecast? Because we are here and we don't know what will happen in year 1, and we don't know what will happen in year 2, 3 and 4. We don't know. So that is why we have to forecast, right? So how do we do forecast? So first of all, before doing the forecast, we need to understand some few terms. Gross profit is basically the difference between sales minus CGS. That is, we all know. Gross profit margin is basically gross profit divided by sale, and sale CGS, it is drawing again, right? Gross profit. After that we do EBIT, right? EBIT. And how do we get income tax? Earning before interest and tax multiplied by tax rate, so you will get this income tax. And depreciation, capital expenditure divided by depreciable life of the investment, and this is straight line. Remember, this is cost of the asset divided by life. You get the depreciation expense for a particular year. And remember that the depreciation is not an actual cash expense. That's the form pay. It is a way of recognizing that the building and equipment wear out and thus becomes less valuable the older they get. Of course, we know that depreciation is a non-cash expense, and it shows that how much the asset has been consumed by the company. Now this part is very important. Okay, so this is a timeline 0, 1, 2, 3, 4. For instance, the project is for 4 years. So you are here, okay, you are standing here as a company finance manager. So you will incur some initial cash flows, right? Initial cash flows. So that is why present value of cash inflows, right? Cash outflows. Initially, that is called the initial cash flows. Remember, cash flows could be inflow or outflow, right? When I write cash flows, mean at the time 0 there could be some inflows, there could be some outflow. Normally we have outflows, but there could be some inflows. So at the end we need to see net cash flows, right? We need to see net here. Okay, and then in the incremental cash flows also interim, this is called the interim one. Interim mean from year 1 to 3, before the final year and after the period 0, all the cash flows are called the interim. So in the interim we will have maybe some addition or maybe have some subtraction we will do, right? We will calculate all this sales, CGS. This is basically called interim, right? And last year cash flow, when I say cash flow, please remember that it could be positive or negative, right? And it is when it is positive or negative, so that is called the terminal cash flow. So it means we will be forecasting incremental cash flows as well as terminal cash flows as well as initial cash flow. Okay, so there are 3 types of cash flows that we need adjustment in. Initial cash outflow, we need some adjustment, then interim we need some adjustment, and then terminal we need to adjust few things. Okay, now we have to first differentiate between cost of goods sold versus operating expenses versus capital expenditure. CGS is basically the direct cost of manufacturing, right, or producing something. So that is actually cost accountant that gives this information. Operating expenses is separate from the factory or from the manufacturing. For instance, you need to pay rent, you need to pay salary, you need to maybe pay the interest rate. All these things basically are the operating the business. This is creating the product. And capital expenditure is basically the expenditure related to the investment. Once you make the investment, and every year that expense is reduced by depreciation. Okay, so the total cost that you incur is called the capital expenditure. Okay, so if you understand the capital expenditure, there is a difference between the cost and expense. Remember, expense is normally a periodic thing. For instance, you bought a car of 100,000 ringgit, right? Okay, so after first year the value of the car is how much? 90,000. Okay, how much is depreciation? Is 10,000, right? So that's why you call it as, this is the depreciation, this is the cost, and this is the book value, right? So this is the expense and this is the cost. Initial cost, expense, and then book value. Book value means the residual value, right? So that is equal to cost minus accumulated depreciation. So that is called the residual value. Okay, so how much is left is called the book value. So you need to differentiate basically between the cost and expense. Expense is the expired part of cost. Expired part of cost. How much is expired? 10,000, right? And if you see cost is unexpired expense. Okay, because this is not expired right now, but expense is expired one. Okay, because we just discussed the depreciation, and depreciation means the expired cost, right? Depreciation means expired part of cost. Okay, so first method is straight line depreciation method, because we will solve some question based on straight line. After that we will do some complex question using makers. Okay, Cameron Industries is purchasing a new chemical vapor depositor in order to make silicon chips. It will cost $4 million to buy the machine. So this is the cost. Cost is $4 million and 12,000 to have it delivered and installed, plus because this is also part of the cost, so that is 12,000. Okay, so that is the total cost is 4 million plus 12,000. Building a clean room in the plant for machine will cost an additional $3 million. Remember, building a clean room is not really related to the machine itself, right? This room is for the machine, right? But this is not an expense not directly related to the machine, so that's why we are not going to incorporate this part, right? Remember, all those expenses that are related to machines, right? For installation was actually related to the machine, right? But this, a separate room, is not directly related to the cost to the machine, so that's why we are not adjusting this one. Okay, the machine is expected to have a work life of 6 years, so life is 6 years. If straight line depreciation is used, what are the yearly depreciation expense in this case? Because it's a straight line, in the straight line depreciation method, the expense remains constant, right? So the total life of the company is how much? 4 million plus 12 million divided by 6. The answer would be, this is the 668.667. okay, so this is the answer B. This slide actually helps you to understand what depreciation method look like and how to incorporate the aspects of the cost. Not every cost is added in the cost of the machine, like separate room cost. Okay, let's read this question for the incremental learning. Suppose that the link system is considering the development of a wireless home network appliance called HomeNet, and that will provide the hardware and the software necessary to run an entire home from any internet connection. Okay, based on the extensive marketing surveys, the sale forecast for the HomeNet is 50,000 units per year. Remember, this units information or the sale information normally comes from the marketing department. Okay, so the sale forecast, how many units? Sale is equal to price into quantity. So this question is for first giving you the information of quantity, how many? 50 units. Okay, given the pace of technology change, link system expects the product will have a 4-year life, n is equal to 4 year, right? And an expected wholesale price of $260. so this is the price, so second part of the sale function. Okay, so this information was for sale. Next, actual production will be outsourced at a cost including packaging of $110 per unit. So basically this is the production cost. So the cost function is equal to C into quantity. Quantity will be same, that is 50,000, but for this quantity the cost will be outsourced, and that is 110. Okay, so at this point, if I want to find the sale is equal to price into quantity. Price is 260, quantity is 260,000, it will be total sale. Subtract the cost is equal to C into Q. C is 110, Q is 50,000, right? So the answer is 55,000. Okay, so what is the gross profit? That is 7,500,000. So if I just solve this one, sale minus CGS is gross profit. If I can also write it like that, because quantity is equal in both cases, so I can take it common and P minus C. So that is price minus cost is the difference of every unit, gross margin of every unit multiplied by number of units, you will get the gross profit. So that is equal to 50,000. 260 minus 110, so 260 minus 110, the answer would be the same, that is 7,500,000. So you can also write a gross profit margin as P minus C, so you can multiply it with quantity to get the total gross profit. Okay, now if you see the third paragraph says that to verify the compatibility of new consumer internet ready appliances with the HomeNet system as they become available, link system must also establish a new lab for testing purposes. So the they will rent the lab space. So remember, they will rent the lab space but will need to purchase 7.5 million of the new equipment. So remember, this is the cost of the new equipment. So the total cost is 7.5 million, right? And the equipment will be depreciated using the straight line method over a 5 years life. So depreciation is straight line, life is 5 year. Okay, links is marginal tax rate is 40%, so tax rate is 40%. At this point you might be wondering that the previously, if you see, the project life was for 4 year, right? So you were thinking that we will be dividing the cost by 4, but now the cost is actually the machinery life is for 5 years, right? So it means there are two different things. Number one, project life, and then we have asset life, right? So it means we will be following asset life. Okay, so depreciation will be occurring for 5 years, so we will be following the asset life. We also will see the project life, but I will mention like what does it mean, what is the difference between the asset life and project life. It means the project will be producing the units of 50,000 for 4 years, right? But after 4 years it is not going to produce anything, okay, but the asset will still remain. Okay, so asset life is still there for how many years? For 1 more year, right? So it means depreciation will still occur in year 5. Okay, so for instance, you have a car and you are using your car for traveling to your university for teaching, for instance, and your contract is for 5 years. But if you see the car insurance is when you bought this car, the car insurance coverage given by the company is for 6 years, right? So after 5 years, for instance, your tenure is over, so it means you are not going to drive the car after 5 years anymore, but the depreciation still will be continued for 1 extra year, right? So that this is the asset life and this is the project life. Okay, now, and the tax rate is how much? 40%. The lab will be operational at the end of 1 year. Okay, at the end of 1 year it will be operational. At that time HomeNet will be ready to ship. Link System expect to spend 2.8 million per year on a rental cost. Remember, if you see this statement, they are going to rent the space, and how much is the renting expense? That is 2.8 million per year. Remember, this is periodic. Periodic means after some time, so that's why it's an expense, it's not a cost. For the lab space as well as rented marketing and support for this product, forecast the incremental earning from the HomeNet project. Okay, now first of all you need to see that this is a new project. This is not a replacement project, right? When it is a new project, then it's quite simple compared to the old project. So all the cash flows of the new project will be incremental. But if it is a new replacement project, of course we need to find some incremental cash flow. We will also see those questions. Okay, this is the calculation part. Number 1, step 1, 4 items to calculate. Number 1, incremental revenue. Remember, we will not call sale, we will call it as incremental revenue, mean how much this project is adding in the company, right? That's why it's incremental. So that's simple. That is 13 million. I just calculated P into Q, P into Q, right? And then cost is Q into C. That is the cost. And selling and administrative expenses, that is only, they have given only rental expenses, right? So that is 2.8 million. And depreciation is the for 5 years. So capital expenditure is 7.5 million divided by asset life, it is 1.5 million. Okay, remember, for the depreciation we don't use project life. Instead we use asset life. Okay, so you need to remember this. Its marginal tax rate is 40%. So how can I find the tax rate? Of course I need to find the income tax, that is EBIT multiplied by the tax rate, but first we need to find the EBIT. Okay, so let's see what do we have here. Okay, so these are the interim cash flows, and this is the terminal cash flow, and this is the initial cash flow. Okay, so this is terminal, this is interim, and this is initial cash outflow. When we have normally when we have a new project, we don't have much adjustment in the initial cash outflow, and we don't have any adjustment for the terminal, right? For instance, if it's a replacement decision and you had an old car, right, old car, and now you are thinking to buy the new car, and the new car cost is 100,000, right? So you have to pay 100,000, but you also have the old car. Of course you are going to sell this car for 20,000, right? So 20,000 you are getting, but how much is the payment for the new car? 100,000. So what is the total outflow, net outflow? That is 80,000, right? So that is why in the start at time 0, when it is a replacement decision, we have some inflows, we have some outflows. Okay, so I will tell you some adjustment. Okay, that's a simple question. So in year 1 we have 13 million, 13 million, 13 million, 13 for 4 years, and this is the cost for 4 years, and this is the gross profit, and selling administration expenses are 2.8, and depreciation is 1500,000. 1500 is how do we calculate it? So 2.8 divided by 5, that is the depreciation expense. Okay, and EBIT is 32, 3.2, 3.2, and finally if you see, there is nothing, no information for revenue in year 5, year 4, nothing, no information, because the project already expired at year 4. Okay, and if you see at the last year, it is due to the depreciation, right? Remember, there is no information for this one, but only information is the depreciation, and depreciation is an expense, right? When it is an expense, we will write negative, so EBIT would be negative, and this is the answer, 1280, 1280, 1280, because EBIT after income tax is how much? 1280, right? 3280 multiplied by 40%, so this is the tax rate. But if you see this one, this is positive, because tax is always on profit. Okay, on loss it is the saving, it would be saving. Okay, so 1500 multiplied by 40%, answer would be 600. Okay, so but this is on negative 1500, so that's why it's a saving, so you will write it as positive. Remember, when it is profit it will be negative, when it is negative it will be saving, right? So how much is the incremental earning? That is 900, negative 900. Okay, at this point we have calculated incremental earnings, not the cash flows. Okay, now we have to convert these incremental earnings into cash flows. So it means on the timeline we cannot write 1920 year 1, 1920 year 2, 1920 year 3, and 1920 year 4, and negative 900 in year 5. We cannot write, because these are the accounting earnings, so we have to convert them, and these accounting earning has a drawback that it can be manipulated, because we have subtracted how much? 1500 from the profit. So it means actual cash is normally higher, but this 1920 is lower because we have subtracted this 1500. Okay, so we have to adjust back the depreciation to get the cash flow. Okay, so in the next slide we are going to convert the incremental earnings to free cash flow. Okay, so incremental earning, we got it. We have to add back the non-cash expense, depreciation expense. Depreciation expense was 1500, we have to add back, and also we have to subtract some capital expenditures. So for now there are no such example for the capital expenditure at the moment, but in the tutorial question I will give you. Okay, for instance, during the project, what happens, maybe in year 3 we also need to incur some additional cost, right? So that is also a capital expenditure that we need to be making. So if we are doing that, of course in the earnings it will be a new expense, so we have to subtract, it will be an outflow, right? Inflows are normally added, outflows are normally deducted. Okay, after that, changes minus changes in net working capital. So net working capital, I explained it now, and incremental free cash, this will be our incremental free cash flow. Remember previously I told you net income plus depreciation, right? So that was cash flow, but now we have to adjust 3 more things if they are available, right? Adjustment, I will call it as adjustment. Adjustment will be in 3 parts. Number 1, depreciation. Number 2, capital expenditure. Number 3, changes in net working capital. Okay, we need to do that. Now what is the net working capital? This is I really want you to understand. So this is 2010 and this is 2011. So current assets, okay, before the years let me explain. Working capital is equal to, net working capital is equal to current assets minus current liabilities. For instance, we have current assets of 100 minus current liabilities are 100, our net working capital is 0, right? It means, what does it mean? It means we borrow current liabilities, we have the short-term borrowings or the current liabilities to buy the current assets of 100, right? That's very simple. We are using current liabilities of 100 to buy the current assets of 100. 100 equal 100. Okay, but what if the situation is relatively different? Current assets are 120 but the current liabilities are 100. Our net working capital is plus 20, right? So this plus 20 is what actually? This is extra current asset, right? This is extra current assets, but we call them, these extra current assets, not current assets, we call them as net working capital. Okay, so it means in this 120 we have 100, we have plus 20, right, minus 100. So it means 100 current liabilities are used to finance this 100 of current asset, but where did this 20 current assets come from? Okay, so normally they came from the long-term funds. Okay, so net working capital means current assets minus current liabilities. In the current assets we have cash, we have inventory plus receivables, current assets minus payables. Okay, so our answer will be net working capital in time 2011 minus net working capital in time 2010. Okay, so that would be the change in net working capital. First of all, that is the net working capital, it is of the same year. Change we calculated for different years. Okay, this is, you need to remember. Okay, now I write this working capital thing again for you so that you understand. Working capital is basically the net working capital is current assets minus current liabilities. So it is equal to 120 minus 110, sorry 100, answer is plus 20. So this 20 is part of current asset, right? That is the extra current assets. current assets not purchased by current liabilities, right? When it is not purchased by current liabilities, then how did we buy it? Where did we buy it from? It will be bought from the capital, right? Capital means long-term funds, right? So it means the net working capital is part of the current assets that are not purchased by the current liabilities. Instead, they are purchased by long-term funds. So that is why if you see in the capital budgeting mean long-term investment, we are using net working capital, right? Because it is not short term, it is long term. So that's why we are using net working capital, and we need to adjust it, right? So that is changes in net working capital from period 1 to period. So this is changes in net working capital. First we need to calculate net working, after that we calculate the changes. Okay, now the rule is if changes in net working capital are positive and if changes in net working capital are negative. Positive means what? Current asset increased from 20 to 30, right? So extra 10. So it means company have purchased more current assets out of its long-term funds. So it means will it be an outflow, right? If increase in working capital, it will be outflow. If decrease in the working capital, it will be an inflow. Okay, so last year we used 40, but this year we are using 30. So we are not buying extra 10, right? So 10 is reduced. When we are not buying, it means we are saving. When we are saving, it means we are not paying, right? It is an inflow, right? So because it is not outflow, it is an inflow. Okay, so this is the rule you need to remember. Okay, I have written the formula for net working capital. If it has increased, so it will be an outflow. If it is a decrease, it will be an inflow. So now let's get to the example, and we forward this example with some changes. Okay, so let's return to home net example, the previous example. Suppose that the home net will have no incremental cash, okay, or inventory requirements. So the cash or the inventory basically are the current assets, okay. However, receivables related to the home net are expected to account for 15% of annual sales, and payables are expected to be 15% of the annual cost of goods sold. Okay, now if you see, receivables are expected to be 15% of the annual cost of goods sold, and 15% sale is account receivable is 15% of sale. So if you see, current assets are equal to cash plus inventory plus account receivable. So cash, inventory, receivables are 15% of the sale. 13 million multiplied by 15, that is 950. So 1950. So that is in year 1, year 2, year 3, year 4. Because it will continue for year 4, the project life is for 4 years, not 5 years. Okay, 5 year is the asset life. It will be 0. Okay, and payables are also 15% of CGS. 15% of CGS is 825. So you can get it here. And the net working capital is current assets minus current liabilities, that is 1125. So you get it for 4 years. Okay, last year we cannot do that because that is a asset life, not the project life. Okay, once we have net working capital, then we can find the change in net working capital. Change means from 0 to 1, is it a positive change? 1 to 2, what is it increase or decrease? 2 to 3, 3 to 4, 4 to 5. Okay, we need to see. So let's say this is the change in net working capital. this is net working capital, and now we need to find change in net working capital. From 0 to 1, it is a positive change. It means it will be plus 1 to 5. It is a positive change. Remember, this positive means positive change. Positive change means an outflow. It should be an outflow. It should be a cost. And from 1 to 2, there is no change, 0. From 2 to 3, no change, 0. From 4 to 5, so it means from in the 4th year we have to buy 1125 current assets, but in year 5 we are not buying anything. So it means when we are not buying anything, we are reducing. It means we are not paying, right? So this will be, although this change is negative, remember, this negative doesn't mean that outflow. Okay, if it is negative, it means an inflow. Don't get confused with the sign. This positive means positive change, but it is an outflow because it has been added. Okay, and negative means that it has decreased, right? So decreased mean it will be an inflow. Okay, now once we have got these earnings, in the first part, if you remember, we got 1920, 1920, 1920, 1920, and then 600. Okay, this is in the first part, if you remember, in this part. So 1920, 1920. Now we are converting them into free cash flow. Okay, so we are in the process of calculating the free cash flow. Okay, next we are convert the incremental earnings to the incremental free cash flow. So after we got the incremental earning, so let's see, add back depreciation. First of all, adding back the depreciation was 1500, 1500, 1500, and then in the final part also we need to add back. Okay, although we don't have anything here, but we have subtracted something, so that is 1500. And if you see, the purchase cost is 7500. Okay, in the start there is nothing, so from 0 to 1 it had increased, right? From 0 to 1 it has increased by 1125. So it means in year 1 we need to incur an outflow, so it will be an outflow. From year 1 to 2 there is no change, so 0, 2 to 3, and in year 4 to 5, if you see, it's a negative, means that working capital decreased. When they decrease, it will become inflow. Okay, so what is the situation now? Incremental free cash flow, it is in the start, year 1, 2, 3, 4, and 5. So now this we can do it on a timeline, that is equal to 7500, right? 0 in year 1, 2295, year 2, 3420, 3, 3420, then 3420, and year 5 we have 1725. So after that you have some discount rate, cost of capital, that is for instance 10%, and then you can simply find the NPV. Remember, in the previous chapter we were directly given these one, but now we have to calculate. Okay, so if you see this incremental cash flow example, you have to note that the capital expenditure is recognized as a cash outflow in year 0. That was actually 7.5 million. So that is 7.5 million here. Okay, so it is an outflow, but if it happens in anywhere in between 1 to interim cash flows, it means we have to adjust. Okay, so you can see that this is the initial cash outflow, these are the interim one, and this is the terminal one. Okay, depreciation does not correspond to the timing of the actual cash flow. Of course, the actual cash flow could happen only for 4 years, but depreciation will proceed for 5 years because it follows the asset's life. Okay, once we have got cash flows, next is to determine the appropriate discount rate. Discount rate is basically cost of capital. Remember, this is our next chapter. Okay, so we are going to discuss in detail. And after that we have the discount rate. We can calculate the NPV. So this is free cash flow at 0. It means it is the present value of cash outflow, right? And then this is the present value of cash inflows, then we can you can find it. And this is the same investment decision rule. The answer is 2862. Okay, so this is in on the timeline, and discount rate is 12%, and we should accept this project because NPV is positive. Okay, now let's discuss some depreciation method. I am sure that you have studied this method in your accounting courses. Depreciation means that is we divide the cost of the asset divided by with its life, then we get the straight line depreciation method. And then we have accelerated depreciation. We call it as the MACRS, or modified accelerated cost recovery system. So it actually provides the table of the percentages, right? And that percentage is applied on the cost of the asset, and then we see that how much is the depreciation expense every year, right? So to calculate the depreciation for each year, we multiply the percentage in provided table. So this will be given even in your exam. If it is given, this question is following MACRS, we will be giving you this MACRS table for that year by the original purchase of the price of the equipment. MACRS allows for the partial depreciation in year 0 when the asset is purchased and put into service. Remember the difference between the straight line. In the straight line, the depreciation does not happen in year 0. Instead, it starts from year 1, right? But in MACRS, MACRS follows that the partial depreciation should happen in year 0 and partial an extra year, right? So it means the depreciation will happen in year 0. Okay, it will start from year 0. So if you see, this is the table, and if you just look at this example, that is depreciation for the recovery period. Recovery period, if it is a 3-year asset, it will be recovered in 4 years. So it means there will be 4 rates. If it's a 5 years asset, it will be recovered in 6 years, right? And why? Because in year 0 it used the partial rate, and in last year it also uses the partial rate. Okay, in year 7, 1 extra year. Remember, we take 1 extra year in the depreciation in MACRS. Okay, let's follow the same previous question. The cost of the asset was 7.5 million, and the life was 5 years. So when it was a 5 years, it means it will be how many rates would be applied? 6 rates would be applied. Okay, so it means it will, when we look at the depreciation table, so it will be a 5-year asset class, but we have the 6 rates. This will be in year 0, 1, 2, 3, 4 and 5th year, right? So if you see, in year 0, depreciation expense -7, it will also happen in year 0, this depreciation expense. And then okay, this is the cost multiplied by this 20%. This is the depreciation expense. And if you see this 32%, 32 multiplied by 7500, -24, 19.2 multiplied by 7500, you get all these amounts. So in MACRS, you simply multiply the cost with the rates. Okay, so these are the fixed rate you have to do. Okay, once we get these depreciation rates, then of course we need to adjust our example. So if you see, how can we adjust this depreciation? Depreciation in year 0 is 1500, okay, and -2400, 44. Remember these depreciation expense, and let's go back to our example and see what happens. How do we adjust? Okay, it means, and there is no revenues and depreciation, we have -1500, right? So we have -1500. After that, 40% and incremental earning would be -900, right? So it will increase the cost. But if you see, okay, I'm coming again. So depreciation in year 1, 0 would be -1500, and EBIT would be negative 1500 also. Okay, so income tax would be saving, that would be 600, and how much is left? 900. Okay, so that is negative 900. After that we add back depreciation, that is 1500. Our answer would be 600. So 600 plus negative 7500, your initial cash outflow would be 6900. Okay, and also in year 1, instead of 1500, our new depreciation would be 2400, and accordingly you will adjust all these depreciation. Okay, if you see, if you follow this depreciation Macker's method, our answer would be 3.179. okay, so let's see how do we get this one. Okay, I have solved the question for you. If we use it using the Macker's, right? So the Macker's rate are given, and from 0 Macker's is 1500, so everything is 0 in year 0 except depreciation, and year 1, 2, 3, 4, 5, so this will remain same, and gross profit, it will also remain same. So these cash flows are same for 5 years, and rent is 2.8, but there is no rent in year 0, so this is the adjustment. And depreciation, now because it is Macker, we will use 0 at 0.0. 1500 is the depreciation, 2400 is the depreciation 1. These are the depreciation based on the Macker's table. We got it. After that, EBIT is negative 1500, 23, 3260, 3836, 3836, and negative 4324. After that, we are going to apply the tax rate of 40%. So it would be not negative because it is loss, so we are going to apply, so we are going to use positive, right? So the answer would be 900, but this one, because it's a profit, so we are going to get expense will be negative, so on in the final also it is negative, so the tax rate would give us the positive benefit, and the answer would be negative 25.259.29. okay, so after that we are going to add back the depreciation. So depreciation was 1500, so our answer would be 600, and we are added back all the depreciation, and finally we also add depreciation of the last year. And now we are going to adjust the working capital. There is no adjustment in the working capital in year 0. In 1 there is an increase 1125, and you know that how to get this one. Okay, in the final year this is decrease. To decrease means it is 1125 positive. So what are the cash flows? The cash flows will be this is the cost of the equipment, so the net cost will be negative 6900, because 600 is the inflow because of that depreciation expense benefit, and now it will be negative 600. And in the year 1 we have 2655, year 2 we have 3396. okay, so and so on. So the cost of capital is 12%, so if you find the NPV, it will be 3.17. okay, now you got it how to calculate the 3.179 NPV, okay, using the Macker's. Okay, now we have some rules for the cash flow estimation. Number 1, we are going to ignore the sunk cost. For instance, we have incurred some cost. Sunk cost is the cost that you used initially for the project feasibility, for instance feasibility report, right, any survey, so that would not be the part of your initial cash outflow. okay, and we will only assign the cost that is related to the asset, right? So that's why any cost that is related to the asset would be the part of the cost. So for instance R&D is the sunk cost, right? So we are not going to include that in our cost estimation. okay, now we are going to exclude the finance cost. Finance cost mean, if you remember, we had EBIT, we did not subtract interest rate, right? We did not subtract, we put it as 0. Why? Because when we do the cash flow estimation, CF1 divided by 1 plus cost of capital, this interest rate is already in this cost of capital. So if we first subtract to get this one as well as we divide it, it will be double subtraction, right? So it will be double counting because we are using that in the denominator later on. So that's why we don't subtract it. So we are excluding the finance cost. Okay. Okay, so project externalities are, for instance, if we had some old project, because of the new project, what is happening, the old project, we have to sell it, or maybe the sale of the old project is decreasing. So that's why that particular decrease in the sales should be accounted for in the cost, right? So we will have some example also, we will see how to do that. Okay. Or for instance, if we are introducing a new project or making a printer, so it will also increase the sale of the inks, right? So these are the externalities. Because of this project, something is happening with the inks also. So with the increase in the sale and the printers, the sale of the inks will also be increase. Okay, so we should include this one in our estimation. Or the lost sale of existing project should be the incremental cost. Okay. And finally, rule 4, include the liquidation or salvage value, also known as after tax salvage value. So that is after tax salvage value. Okay, so let's understand this one. For instance, you bought a car for 100,000 and it will be used for 5 years, right? But now the the life of this car is 6 years, but the project in which this car is being used is for 5 years. Okay, so it means we are going to use this car for 5 years, but the car life is 6 years, right? So it means after 5 years, when the project will be over, it will still have some life, right? For instance, after 5 years, the depreciation charge is, let's say it's 90,000. So how much is left? 10,000, right? So this is called the accumulated depreciation, right? Total depreciation, and this is the cost, and this is called the book value, or it is also called the salvage value. Okay, so if this is the book value, right? So it means according to the true value, if we deduct the accumulated depreciation, whatever is left is 10,000. Okay, so according to books, the worth of this car is now 10,000, but when we sell it in the market, we can sell it in 15,000 instead of 10,000, right? So it means we can earn 5,000 extra. So it is called capital gain, right? So when you have capital gain, of course you pay tax rate. Okay, so we have to include the liquidation. Normally at the end of the year, we adjust this. This is adjustment in the terminal year, right? So this is the adjustment for the terminal year if the project is new. But what if the project is okay, I will explain it in later part. Okay, so it means now we can sell our car for 5,000 extra. So sale price is 15,000, book value is 10,000, the answer is 5,000, right? So on 5,000 we are going to pay, this is called the capital gain, and we are going to pay the tax rate. Okay, so the tax rate is here, capital gain is here. So sale price minus capital gain, how do we do it? Basically sale price minus book price, you actually the capital gain multiplied by the tax rate, you reduce this one. After that you get the after tax cash flow from the sale of the asset. Okay, so let's see for the example first, then we will easily understand. Okay, this is the example of after tax cash flow from an asset value. Please first you need to remember that the book value was, let me repeat the example again. So that was equal to 15,000, sorry, so that was equal to cost minus accumulated depreciation, right? Cost was 100,000, accumulated depreciation was 90,000, so the book value was 10,000. So we are talking about at year 5 last year. Okay, so this is called the book value, and when we sell it, market value was 15,000. So what is the difference? So what do you get actually? You get market value, you get 15,000, right? Because when you're going to sell it, the cash flow would be 15,000, right? After that you are going to pay tax on this one. How do you pay? You subtract it. And how do you pay the tax rate? Tax rate would be 40% multiplied by capital gain. Capital gain was how much? 5,000. Okay, so then you will subtract this one, and this will be your cash inflow, okay, at the last year. Okay, let's see this example. As production manager, you are overseeing the shutdown of a production line for a discontinued product, okay, and some of the equipment can be sold for a total price of 50,000. The equipment was originally purchased 4 years ago for 500,000 and is being depreciated according to a 5 years Macker's schedule. If your tax rate is 35%, what is the after tax cash flow you can expect from selling the equipment? Okay, you need to do following steps. Use the Macker's, determine the book value. That's very easy. First of all, we need to see that this asset is a 4-year asset and it was purchased 4 years ago at the cost of, so the cost was 500,000. Asset class is 4 years. Sorry, asset life is, it was purchased 4 years back. So when it is a 4-year asset, if you see the Macker's table, and the rates would be, because there is no 4-year asset class here, but we can use the rates of the 5 years, okay, because it is for 5 years, rates would be 6, but if it is a 4-year asset, rates would be 4, 1 2 3 4 and 5. Okay, so we are going to use these 5 rates: 20, 32, 19.20, 11.52, 11.52. Okay, you can see that 20, 32, sorry, these rates are actually the given rates. Sorry, I'm 20, 32, yeah, these are 19.20, 11.52 and 11.52. so these are the rates that we got from this table. Okay, so we are going to use these rates because 4 years were not separately mentioned, but it can be found in 5 years table, right? So that's why we can do that. Okay, so the cost was, the cost of the asset was how much? That was 500,000. so the cost was 500,000, number 1 2 3 4 and 5. So just subtract these rates, right? So 20%, then 32%, 92%, 19.2% and 11.52%, sorry, 11.52%, and your answer would be, if you subtract all these, your answer would be 28,800. okay, so this will be your book value, and all of this will be your accumulated depreciation. Okay, so in the first part they have calculated the accumulated depreciation because it's at 20%, so you will get this answer. Then with 32%, this is the answer. So 1 2 3 4 5 5 rates are being used, and the accumulated depreciation will be 47150. so this is this part. Okay, so then you have a purchase price, that is 500,000 minus this accumulated depreciation, so that is the book value. And the book value, if you see, that is equal to 28,800. And now the market price is how much? If you see, the market price is 50,000 market price, and the tax rate is 35%. Okay, so now we need to do the capital gain. So market price is 50,000, book value is 28 something, like in the previous example. And now we need to find the after tax salvage value, after tax salvage value, right? So salvage value, first of all, is equal to 28,800 is the salvage value. So the market price minus tax into capital gain. So if it is a capital loss, then it will be added. Remember, capital loss, it will be added, but because this is the capital gain, so we have to pay the tax. Okay, so 50,000 minus 2800, 21,200 is the capital gain, so we have to multiply it by 35% to get the tax rate. So this is the tax payment, and you are receiving this 50,000. So net cash flow would be 42,580, right? So this would be the after tax salvage value. Okay, now we have 3 more rules, that we have to include all the opportunity costs, right? So it means if we are bringing in a project and we are losing another thing, so what is that actually cash flow? We have to add it as a cost, right? So all opportunity costs must be included as a cost, and working capital is not depreciated because it is an investment that will be recovered partly or fully. Of course, working capital is an investment, right? Because that is being, and it is, first of all, this is not a long-term asset, but working capital is the additional current asset, so that's why depreciation is not being applied. Okay, so working capital is not depreciated, it is just an investment in the current asset, so it will be recovered at the end of the project, of course. So increase in net working capital is outflow and decrease in is an inflow. And rule number 7 is timing of the depreciation expense depends on the depreciation methods. If it is a straight line, if it would be year 1. If it is a makers, it would be year 0. Okay, now this is a useful template for free cash flow calculations. We need to years, revenue, cost. This is a gross profit, operating expenses, depreciation. This is income tax, right? So incremental earnings, after that we adjust it, we convert it into incremental cash flows. First of all, we add depreciation, subtract the capital expenditures, change in net working capital, after tax cash flow from the sale of the asset we just saw. If ATSV is there, so it is positive, then positive. If it is negative, then use. If it is a capital loss, it will be negative. Okay, negative opportunity cost. If there is any other cost, then for instance, you are building a machine, you are building a new plant on your land. Previously this land was giving you 100,000 every year, but because of this new plant, you cannot earn this extra rent, right? So that will be part of your opportunity cost, so it will be total outflow, so that will be incremental free cash flow. Okay, so this is just another way of writing the incremental earnings. Once you write the incremental earning, then you can find the free cash flow. So this is you can follow, but I would recommend that this method is very easy to understand.
Finally, we have the mind mapping of this chapter. So if you see, we started from the fundamentals of capital budgeting, and there we studied that in fundamentals of capital budgeting, we learn how to estimate the cash flows, right? So this chapter is for cash flow estimation, and we do cash flow estimation for the project, and the project can be a new project or it could be a replacement project. Okay, so whether it is a new project or replacement project, we have to have 3 types of cash flows. Number 1 is initial cash flow, we have interim, and we have last is terminal cash flow. in the initial cash flow, if you see in the timeline, every time we draw the timeline, we always have this cash flow first, right? CF0. So how do we get this? So this is actually called the initial cash flow, and we learn how to calculate CFO is cost of asset, purchase price, any change in net working capital. If it is increase, it is negative. If it is decrease, it is positive. Then we have capital expenditure. Capital expenditure, because this is expense, so it will always be a negative one. Okay. Lastly is the sale of old asset. So it means if we are selling some old asset, especially if it is a replacement decision, right? So we are buying a new project, and if we have a old asset also, so it's a replacement decision. So this after tax sale value of old asset, when you are doing it in the initial cash flow, so normally it is a replacement decision. Okay, so you are selling your old car and buying a new car. Of course, when you are selling your old car, then you will get some cash flow. Okay, so that is called initial cash flow, CF naught. So we will get it here. After that we have one cash flows, 1 2 3 4 5 6 before the terminal one. All these cash flows are called interim. And how do we get sale? P into Q, CGS is C into Q, and gross profit. Normally questions either give you price into quantity information, or either they give you directly sales information. So they can either give you the information from P into Q or C into Q, or either they will give you a direct information of sales or cost of goods sold. After that we will deduct rent, all the operating expenses including depreciation, and we know that in depreciation we learn macros as well as straight, or it could be a declining or double declining balance method. So we have different types of depreciation. Okay, so please remember, if even it is macros, so please use to include year 1 as your first depreciation expense. Okay, so then we have EBIT, operating income. Then we deduct tax, and then after that we get net income. We call it as EAT, earning after tax. We also call profit after tax. After that we add back our depreciation to get the cash flow. Then we adjust the working capital. If it is increased, then it is negative. If it is decreased, it is positive. And then we have capital expenditure. Yeah, I mean during the course of the project we can also incur some extra capital expenditure, so it can also be true. Okay, so CF1 means any individual cash flow. Okay, then we have last terminal one, CFT here. So everything remains same until this capex. Lastly, what do we do? Actually, we do sale of asset. Normally, for instance, this asset, a new project was there for 10 years, right? So what happens at the end of 10 years? Of course, we are going to do something for this project. We are going to sell it. Okay, so that's why we have some proceeds from sale of the old asset. Okay, so that's all from today's lecture. Thank you so much.